Hi, good afternoon, everyone, and a warm welcome to all on this webinar on creating and managing personal wealth by our CFO, Mr. Shantilal Dugar. It's a delight to welcome everybody who has joined us in this webinar, and I'm sure a lot of our colleagues in Opus and outside Opus might be looking at uh, this webinar with multiple uh, levels of interest and needs. And hopefully by end of the webinar, we'll be able to address many of them. This webinar is a part of several initiatives that we have planned in this Learning Fest. So, as many of you might be aware, we celebrate Learning Fest in ABG and in Birla Opus, wherein for 3 months, August, September, and October, there are multiple initiatives, including webinars, e-learnings, and self-learning courses, actual physical training programs, and multiple RNRs and other initiatives through which we empower employees to take charge of their learning and develop themselves, and also introduce many different and innovative methodologies for learning and development. Uh, as a part of the webinar series, we'll be bringing to you a lot of our leaders on areas that is relevant to each one of us in both our personal as well as professional life. Today's webinar will focus on personal wealth, and I believe we have the best leader across the group to help us in taking this journey forward with us. Mr. Shantilal Dugar has spent 34 years in the Aditya Birla Group. 16 years has been in Australia and Thailand, and the rest of it has been in India. He's been a part of various businesses across sectors as a part of the tenure. Outside the professional life, Shantiji is also the author of 7 books on investment, finance, future and options, hedging. And he also has written a book called Pearls of Wisdom, which is on life lessons, on things that will make a difference to each one of us on the quality of life overall. So, Shantiji, in today's webinar, we'll be focusing more on the wealth and the finance aspects. And a lot of colleagues along with me are very, very keen to understand how do we maximize our own wealth. Uh, Opus overall is less than 30 years old today. So I'm taking that as a persona to say most of the colleagues who are listening to us might be in their 20s, 30s, sometimes 40s, and would be in different stages of life in terms of marriage, children, personal needs, etc. Wealth is equally required and critical at each stage of life. And today's webinar will attempt to declutter and help each one understand avenues which are different, options which are new, and methodologies which can help us better. So that's the intent. I also wanted to share with everyone that the initial 30-40 minutes would be Shantiji sharing many elements of the topic of creating and managing personal wealth. But we also will have good time for Q&A, and the Q&A tab is live. So please do keep it alive and keep asking questions, which we will attempt to take at the end of the session. So with that, let's begin. Shantiji, over to you.
Thank you. Thank you, Rakesh. And good afternoon, everyone. Those who have joined from Birla Opus or outside Birla Opus. Let me share my screen. And once it is live, Rakesh, can you please confirm that I am audible and my screen is visible?
Yes, sir. You're audible. The
Yeah,
screen has not been shared yet. Yes, it has
I
come.
have.
It's visible.
It has come.
It is visible.
So
Yes.
the topic today given to me by Rakesh, our learning and development head, is creating and managing personal wealth. This subject is very close to my heart. So I would like to share some useful tips. How can we all create and manage the personal wealth for ourselves? Before I begin, the importance of wealth, as you know, financial wisdom is essential for a good quality life. If you have good money in your pocket or in your bank balance, your properties, then we all can live a good quality life. But how do we create? I think this is important from smart living and spending and investing. By doing smartly, we can multiply our wealth. And in this presentation, I will give you few simple and practical tips to make money, to save money, and to grow money multiple fold. So the first and foremost tip from my side is to create wealth is convert all your costs from fixed to variable, whatever we can possible. For example, I gave one example of let's say owning a car versus hiring a car. So if you hire a car, we just pay on actual use basis, pay as you use model. We only pay with the fare. Whereas if you own a car, there is a fixed cost of driver salary, the car washing charges, equipment maintenance, insurance, registration, etc., etc. So if you convert costs from fixed to variable, it helps to save money when you are not using that asset. Second useful tips, it's just opposite for income. Convert all your income from variable to fixed. That means wherever we are going, whether we are sleeping, we are on a picnic, or we are enjoying the life in hills of Switzerland or New Zealand, our income meter should be on all the time. And few examples how incomes can be fixed, like if we invest smartly through in bonds, in fixed assets, fixed deposits, warehouses, then we get interests, dividends, rents, royalty. If you write some good books, you can get fixed royalty on the sales and some fixed commission. So convert all your expenses from fixed to variable and income from variable to fixed. That's the key for generating wealth. And the third important tip is spend less than what you earn. That means living within your means, cut your coat according to the cloth you have, and save a little bit for future exigencies and opportunities, and avoid at all costs the luxury lifestyle. You don't have to spend just for the show off or pomp and show or uh, in copying somebody else lifestyle. So I give some example here of a simple analogy of a bucket and with a jar. You see in this bucket, there is no water at the moment. It's empty and tap has just started. So a mug is there on the side of the bucket. Can you take out the water from the bucket? No. Immediately after starting the tap, the water quantity will be very, very little and you can't take out any water out of it. Assume this water in the bucket is your surplus money or whatever you have saved so far, accumulated savings. And water taking out from through the mug is your expenditure and inflow from the tap is your income. So the meaning is if there is no initial surplus money in the bucket, you can't spend, you cannot take out anything from the bucket. Once there is an adequate water comes into the bucket, you can take out some water out of this mug. And then your capital appreciation will start happening. For example, in this bucket, you see, assume this water in the bucket is about 100 liters and inflow of the tap water is about 20 liters per hour and outflow is 25 liters per hour. You are consuming more than what you are getting as a intake to the bucket. So 5 liters every hour you are losing out, and this accumulated 100 liters of water will be finished after 20 hours, and the bucket will be entire empty. So if you that means if you spend more than what you earn, someday your accumulated savings and the entire surplus will get over, and you will be having no cash to spend for future. Just opposite to this, if your intake of the water is 20 liters per hour and outflow is 15 liters per hour, so you are saving 5 liters per hour, and even if the bucket is empty in the beginning, after 20 hours your bucket will be full of 100 liters. So that's the analogy I have just explained in the simplest word. To same holds true for all our income and expenditure, and the savings is the basically wealth creation, the net surplus what we generate. Now How do we control our expenditure? There are few tips from my side to create wealth. Save more than double the rate of inflation always, because if you save less than the inflation rate, then in real terms, your purchasing power after 20 years, 30 years will be much, much less, and you cannot buy the same thing what you could have bought today with that kind of money. So your saving rate should always be at least 2 times the rate of inflation of the country. Then second tip is spend out of recurring income and never spend out of your capital. So your capital should always keep growing. If you spend from your recurring income, then whatever you save will be addition to your capital appreciation. So that's the second point. Third point to remember is never borrow and spend. That means you should not take money just for spending from somebody else and keep spending, except for if you are borrowing for any future generating income generating assets, then this is fine. Otherwise, to live a lifestyle of luxury, you should never borrow and spend. That means live within your own means of your income. And to the extent your recurring income is allowed you to spend. The fourth point is do not spend for the sake of spending to show off or copy somebody else's lifestyle, as I said earlier. The other aspects to reduce and control expenditure is to follow these 3R principles: reduce, recycle, and reuse. Reduce always the wastes, recycle the waste, and reuse the waste. Some of the examples I have given, how can we save, and my experience is that if we follow these three principles of ours, we can at least save our expenditure by 30 to 35% easily. If we stop reducing waste food, waste of clothes, recycle the old items and reuse them in a different manner, we can really save a lot of money in the long run. Now, once you have some money saved, then how do you grow it for future? So here I have given some simple example: power of compounding at 6% per annum interest rate, at 12% interest rate, and 18% interest rate. Or if your ROI is 6%, 12%, or 18% on your investments, with simple interest, you will make only 4.6 times in 18% rate. But uh, but in if you compound it with after 20 years, 18% will your 1 rupee will grow to 27.39 rupees. And at 12%, it will become 9.65 times. So 1 rupee will become 9.65 times. And similarly, 1,000 rupees, if you saved on the first year, it will become now 9,646 in at 12% rate and 27,393 rupees after 20 years. If we extend this to 50 years and 100 years, you can see the power of compounding here. On 100 years, if I take the example, 1 rupee after 200 years at 18% becomes 1 crore 54 lakhs 24,132 rupees. And if you have only saved 1,000 rupees, let's say today, after 100 years, your great 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 grandson will get about 1,542 crores 41,031,905 rupees. So this is the power of compounding at 18%. Even at 12%, if you can save and earn, you will be having just 1,000 rupees will make you 8.35 crores rupees after 100 years. And after 50 years, it will become 39 lakhs 27,000 for 18% rate, and 12% rate 2 lakh 89,000 just for 1,000 rupees. So this is the power of compounding. The other secret of becoming a billionaire is invest regularly and get compounding returns. That in the previous example I just gave, one time invested 1,000 rupees and it became 1 crore 54 lakhs after 100 years. But if you invest every year 1 rupee only, so after 100 years, the 1 rupee will become 10 crore 11 lakhs. So can you see the power of compounding here? And if you save 1,000 rupees every year, then you can say after 100 years, your great 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 grandson will get 10,111 crores rupees. So this is the like it is more than billionaire, I would say. And even at you earn 12% return on compounding basis, 1,000 rupees saved every year will make you 78 crores of wealth creation after 100 years. And after 50 years, it will be 2.57 crores on 18% basis and 26.88 lakhs on 12% basis. Now, once you have surplus money, how to invest, where to invest? So the basic fundamental principle here is diversify your investments across assets classes like real estates, equities, bonds, commodities, etc. Don't put all your eggs in one basket because each asset class appreciates at a different rates and have different kind of risk and stability. So always follow a mixed investment strategy to grow your investments in the long run. So there are few tips regarding investments. I think first fundamental tips is don't allow your surplus money to remain in your saving bank account too much, because saving bank account does not give you adequate return. It's only give 2-3% return. So always keep only next 3-4 months of your spend amount in the saving bank. Rest you should invest in productive assets which can grow on a compounding basis. That's where the difference will come. If the money is lying in saving bank account, it will suffocate and it will not grow as fast as you expect it to be. The second fundamental principle to save and grow investment is minimize your tax outgo. And how do we minimize? By not trading too frequently in the equity market or in the asset whatever we have invested in. Keep the asset for a long time, then your transaction cost will be minimum and your capital gain tax also will be minimum, and that's how you can grow your investments fast. And if you are investing in some foreign assets like foreign equities or overseas mutual funds or some overseas real estate properties, then always invest in those countries where the currency appreciates normally, like US dollar, euro, Japanese yen, Australian dollar, Canadian dollar, Singapore dollar. Don't invest in those countries where the currency keeps depreciating. So their nominal capital growth could be very, very high. But in real times, after 20 years, 30 years, if you convert into your local currency, the appreciation may not be that much if the currency is depreciating for that country. So these are 4-5 fundamental tips for growing the investment fast. The next is question comes, how much should we invest in debt and how much should we invest in equity, and what is the right mix? So the thumb rule is the proportion of debt should be equal to your age. So for example, if you are 25 years of age, then you should invest 25% in debt and balance 75% in equity or other assets. As your age grows up, you become 30, then ratio changes to 70-30, equity and debt. The moment you become older to 40s, then ratio reduces from equity 70% to 60% and debt increases from 30 to 40. The moment you become 50 plus, it should be 50-50 in that ballpark range. And once you are in the senior citizenship category 60 plus, then equity portion should be reduced to 30 and debt portion should be increased, because the debt has high, and debt, when I say it means the high quality debt, the AAA bond, AAA rated bonds, or some good quality fixed deposits with the good banks. It should not happen that we invest in poor quality debts at a much higher interest rates, because one bad investments can ruin the entire savings what you earn on interest on that debt. Now, another tips for better investment strategy is avoid mixing insurance and investments. Insurance you are normally taking for your social security, your future protection of your family members. So never mix, never consider insurance as a investment return objective. The objective of insurance and investment should be separate. Always invest which in those assets which can beat the inflation rate. If the investment return cannot beat the inflation rate, then there is no point in investing. For example, if the FDR interest rate is only 5%, 6% below the inflation rate of the country, then by investing in FDR, we are actually losing the real value of our investments in the long run. And as I said, diversify smartly and don't over diversify, because if you over diversify, then it will suffocate your return on investments. The ideal diversification is only 10 to 15 good quality instruments. If you invest, that is good enough to grow your portfolio. And use the tax planning under ATC options like ELSS, PPF, NPS effectively to minimize your tax outgo on the capital gains and other recurring incomes. Now, coming to some tax saving investment instruments options, I have summarized here a few options for you. Section 80C of the Income Tax Act gives us the benefit of up to 150,000 rupees per annum deductions, and all these investments like equity linked saving schemes, PPF, EPF, NSC, tax saving FDs, Sukanya Samriddhi Yojana, life insurance premiums, home loan principal repayments, etc., are all covered under this 1.5 lakhs limit. And in some, there are a lock-in period of 3 years, some there are lock-in period of 15 years, and these are very normally very low risks investment, mainly from the tax saving perspective. Then there are some NPS benefits under section 80 CCD1, which is also covered under this 1.5 lakhs limit. But if you want to invest something extra, then my suggestion would be you invest additional NPS as an optional savings for tax under section 80 CCD 1B, and there you get additional 50,000 rupees exemptions. And the catch point here is you have to keep that money till you achieve the age of 60 years. So you will see the color of your investments only after 60 years of your age as pension. ATD gives you health insurance premium deduction up to 25,000 rupees. And for senior citizens, it is 50,000 rupees. And this you can save every year on your and your family's health insurance premium. And then there are some other 80 benefit on saving account interest up to rupees 10,000. 80E gives you education loan interest reductions up no limit here. Up to 8 years, you can get the tax-free deduction here. 80EE also gives you some, if you are a first-time home buyer, and if you have taken loan against that, the interest on that portion up to 50,000 rupees and will be available in addition to rupees 2 lakhs reduction, which is available under section 24B. And then here there is no lock-in. 80 EEA, like if you are buying some affordable house and if you're taking any loan against that, up to 1.5 lakhs rupees, you can save under this. And this is also tax-free bonds of National Highway Authorities and IREDA. You can take without any limit, but the lock-in period will be slightly longer here. So these are a few simple tips for tax saving and how do we invest in good assets, secured assets, and at the same time get some tax benefits on this. Now you have invested, you have got, let's say, some capital gain on your investments, and if you want to divest and sell some of the investments to use for future, and you earn some capital gain tax. So how to save that tax? Here are few examples, like these are the capital gain tax rate and definitions. Listed shares and equities, you have to hold minimum 12 months to qualify for long-term capital gains. And short-term capital gain tax is 20%. Long-term capital gains tax will be 12.5% above rupees 1.25 lakhs per year. And there is no indexation benefit allowed now on long-term assets, long-term capital gain assets. Then on property, if you have invested in real estate, you have to hold it more than 24 months to qualify for long-term capital gains lower slab. And here also the short-term capital gain tax rate is as per your normal income slab, and long-term capital gain tax rate is 12.5% or 20% with indexation benefit. Debt mutual funds, you have to hold for more than 24 months. Gold, unlisted shares and collectibles you have to hold for more than 24 months, and these will be taxed as per your normal income tax slab. And if you qualify for long-term capital gain, then your tax rate reduces to 12.5%. And here also no indexation benefit is allowed. Crypto assets anyway is short-term capital gain 30%, and both long-term and short-term are 30%. No duration defined here. Rural agriculture land, if you have anything and you are selling it, then short-term capital gains is also exempt. Long-term capital gains is also exempt. Now, once you have the capital gains, how to even optimize it further? These are the few tips like under section 54, 54B, 54D, 54EC, 54EE. There are several sections under the Income Tax Act, where by reinvesting the money what you have got through this divestment, you can save a lot of tax on your capital gains. For example, if you have sold some residential house property, but bought another residential house property within 1 year before the sale or 2 years after the sale, or construction within 3 years after you sell, you can save the long-term capital gain tax on that up to the amount invested. Then 54B allows you to save tax on your agriculture land used for more than 2 years. But the condition is you have to buy the new agriculture land in return of that. And there also you can invest within 2 years of the previous land sale. You save on the whatever capital gain you earn or the cost of new land, whichever is lower, you save that. 54D is applicable when you have a land building under compulsory acquisitions. This may not be applicable for many of us. 54EC, if you have any land or building and you invest in certain specified bonds like NHI and REC corporation, then and if you invest within 6 months, then you get up to 50 lakhs rupees per financial year as exemption under the Income Tax Act 54EC. 54EE is any long-term capital assets. If you buy units of any specified fund, then again within 6 months, if you invest, then rupees up to 50 lakhs rupees you can save per financial year. 54F gives you long-term capital gain other than house property. Other than this 54, if you have invested in residential house, and in that case, the main condition is that the new house should be purchased within 1 year before or 2 years after, or if you are constructing a new house, then within 3 years of the sale of that asset, then you can get LTCJ exemption proportionate to the investment in the new residential house. 54G is the industrial assets in urban area if you are holding, and if you are buying another asset in non-urban area, then again you get LTCG benefit equivalent to the cost of new asset or LTCG, whichever is lower. And 54GA is industrial assets in urban areas, which you convert into assets in some SEZ. And 54GB is residential property sale, but you buy equity in eligible startup companies. Then you get LTCG benefit or investment amount, whichever is lower. The only condition is that you have to invest within 6 months of the sale of this property. So these are some of the tips for optimizing the tax saving on capital gain, what you earned in the long run. So to summarize, before I open the floor for Q&A, the golden rules of creating and managing your wealth and growing it on compounding basis are like convert costs from fixed to variable and income from variables to fixed. Spend less than what you earn. That means remains within your means. Cut your coat according to the cloth you have. Follow the principles of 3Rs: reduce, recycle, and reuse. Invest smartly and diversify, and start investing at an early age so that it compounds fast. By the time you become old, it will multiply your investments and capital to multiple fold, as I explained in the compounding principles. Then avoid unnecessary borrowings, and don't borrow just to show off or copy somebody else's lifestyle. Do adequate tax planning and takes care of your transaction cost. Invest for long term so that your transaction cost will be lower and you will get long term capital gain tax benefits. And consider transaction costs and foreign currency fluctuations while investing. These factors also plays an important role in creating wealth for future. So with this, I end my lecture here. Thank you very much. And with this, I would say personal wealth is built not by income alone, but by the discipline to spend wisely, save consistently, and invest smartly. Thank you. Wishing you all the best.
Thank you so much, sir. Extremely invaluable. There are many questions that have been coming, and I've kept them on hold to allow the flow of the session to get completed before we move on to the Q&A.
Yeah.
But I just wanted to share that there are many chords that stuck when you were sharing it. And I think a lot of learning will also happen through answering of the questions that you will give. Right? And one of the questions was, can you please share the list that you just showed us also? So the deck that we currently are showing of the instruments that I can use for saving capital gains, etc.
So should
There
I
are
share it
people asking
again?
whether it can be. No, people are asking whether it can be mailed to them or it can be shared with everybody else.
Yeah. I think
Just
I
wanted to
can
check
mail
it.
the presentation to you, Rakesh, and then you can circulate to everyone because this is very generic
Great.
presentation I have created. And uh, I I have just put simple points in a structured and systematic manner. I have not used any financial jargons or very difficult investment jargons to make my point clear. So you can circulate to everybody, no issues.
Certainly. Thanks. So one of the questions that came in was, rural agricultural land. It is completely exempt. Who can buy this land? Are there any prerequisites or can anybody purchase it?
Anybody can purchase. Only foreign nationals cannot buy, and uh, even Indian person of Indian origin, they also cannot buy. Suppose I have like if I move from India to some other countries and take citizens of that country, then if I want to buy any agricultural land, I cannot buy. Other than that, any Indian citizen, uh, any resident can buy.
Great. Thank you. That clarifies. Another question from Amol is the educational loan benefit that you showed us. Is it something that can be only taken for self, or can the dependent also be
Dependent also
eligible
are
for it?
included. Dependent. Your children are also included in that.
That's very helpful.
Yeah. Yeah.
There is Ashish asking, can you share the summary of golden rule slide? Of course, we will share the slides with everyone else. There's a question, sir, very specific, but I think it'll be helpful for if you can touch that. That when we are selling a house to save long-term capital gain, is the new house to be purchased 1 year before or within 1 year of sale? Can you please clarify?
So it's either 1 year before the sale of the old house, or it could be within 2 years from the sale of old house, or if you are constructing a new house, then within 3 years of the sale of old house, you should construct a new house to
Okay,
get the 54 exemption, section 54 exemption.
understood.
Should I put the slide again? Because that will make the point very clear to the,
Sure, you can show it for a few seconds. The
yeah,
people
I
who are
will
keen
just
to
show you.
understand this, it will clarify them.
Because this is very important and it can save a lot of tax. Can you see my screen?
Yes,
So
it is
section
visible.
54 says if you sold some residential house property, but buy another residential house property within 1 year before the sale of this property, or within 2 years after the sale of this property, or within 3 years you construct a new house from the sale of this property, then you get the exemption. And exemption, maximum exemption allowed is up to the LTCG amount or cost of new house, new asset, whichever is lower.
Okay.
So suppose
Okay.
you get here 50 lakhs profit and you invest in a new house 16 lakhs. So up to 50 lakhs will be exempt. If you invest only 40 lakhs in the new house, then only up to 40 lakhs will be exempt. Remaining 10 lakhs will be taxable. I hope
Sure,
I
sir.
am clear. Yeah.
That clarifies a lot. There are some specific questions, and I'm assuming, like I mentioned before, there are a lot of youngsters amongst us, people who are in their 20s and 30s. One of the questions that is coming up is, what is the best investment option when you are in your 30s? Because there are many options like, stocks, SIPs, bonds. Which would you consider the best investment option when I'm in my 30s?
So when you
Mithu
are
is
in
asking
your
this.
30s, I said the golden rule is 30% in debt, high quality debt, and remaining 70% in equity. When I say equity means it could be equity, it could be property, it could be gold, the one which is not related to debt, where the return is not fixed. Debt, the return is fixed, right? So you can invest in your NPS, you can invest in your good quality blue chip stocks after doing a thorough fundamental and technical analysis, so that by the time you retire or close to 50, 60, the compounding appreciation of those assets will be much, much higher.
Okay,
Yeah.
cool. Uh, and I wish everybody at the earlier part of their life started doing this, because your power of compounding is a stark reminder of how
Yeah.
wealth can multiply as the years continue. But on a
Yeah.
lighter vein, sir, when you
Mm.
showed us the water in the bucket and jar,
Mm.
about how you have to save and then you spend whatever is left of savings, I'm
Mm.
recalling many colleagues of mine, and I myself was in this area a few years back, discussing that I'm keenly waiting for my salary because my credit card outstanding is pending and my loan EMI is pending. And if I don't get my salary, I'm worried because my debts are already there. So even before I'm getting my salary, I've already spent money. So I'm waiting for the
Mm.
bucket to fill because my jar is already getting filled. But
So
that's a question from somebody in the 20s who has asked, how do I escape it? Because the needs of today's world is far higher and I'm not able to, my income is not able to sustain that. So is there any advice for me? Is the question.
yeah. So the best advice is, I think before you tap your credit card to the machine, you should be aware how many times and how much amount I am tapping for. Okay. And if I am tapping for higher than my income, which is yet to come on 1st of the month or 31st of the month, then I'm heading for a disaster. So be mindful at the time of tapping itself before making any online shopping or credit card spending, that how much I'm doing. As I said, you have to first allow the bucket to fill little bit. Then only you can take out water from the mug. If the bucket is empty already, and if you have already spent, your outflow is more than your inflow rate, then your bucket will never ever fill whatever you may earn. If you earn 1 billion rupees, but your expenditures is 2 billion rupees, you may be one day your bucket will be empty, right? So to get the bucket filled, your spending has to be lower than the income, and then it will multiply very fast. After 2 3 years, you will realize how fast it multiplies if you invest in a very productive assets and compound it at 10%, 12%, 18%. 18% if you compound, then you are the genius, I think. You will make 1 rupee equal to 1.54 crores for your great great grandsons. And
So there
even
is a
at
question about
12%,
that. I will come to that.
yeah.
There is a very pertinent question about the percentage that I'm able to get in instruments. I'll come
Yeah.
to that in a bit. I'm just taking some questions before that. So one of the questions from Prashant is, I'm a new tax regime person. Do you think an ELSS SIP is better for me or a regular SIP is better for me? Because anyways, mine is a new tax regime. What would be your advice?
So ELSS,
So for the purpose of everybody else, ELSS SIP is tax saving SIP, which has a lock-in of 3 years. So sorry,
yeah,
sir, your advice.
yeah. So ELSS is always better. Of course, you get tax saving on that, and your normal SIP is also grow, but you don't get the tax benefit on that. So whether you are new tax regime or old tax regime doesn't matter. You should save tax ultimately.
Okay. So you're
Hmm.
saying always take ELSS SIP first.
Hmm.
Apart from
But on
returns, it will
top of
also give
that,
you
if you
tax
can do
savings.
some more SIPs, if you have surplus money, keep on investing in a productive way. As I said, keep only 3-4 months of spending amount in your saving bank account. Rest all should be invested in productive assets. Otherwise, if you keep money in your saving bank, it will never grow in the compounding rate basis. It will just grow at 2 3
Got it.
percent. So
Okay. Ashutosh has a question. How frequently should we revisit and review our personal investment portfolio? Should we do it quarterly, annually, or is it all based on market movements?
whenever you get time, if you have time, daily basis. If you have time, less time, weekly basis. If you have more or less time, fortnightly or monthly basis. So revisit means I don't say ki you churn your portfolio every week or daily or monthly. You just keep a watch how the situation is going, macroeconomic, microeconomic situation is happening, prices are there, stock market going down or up. Just keep a close watch. You don't have to take action on daily basis. Take action only when it is warranted to take action. Sometimes for 2 3 years you don't do any transaction, but when the opportunity comes within 2 days you can make equal money to the tune of 2 3 years equivalent income. So you have to wait for the right opportunity to come to buy and invest. You should never invest when the market is peak and everybody is greedy. When everybody is greedy, you should be panicky. When everybody is panicky, then you should be greedy. So this is the first fundamental golden rule to make money through the stock markets.
Indeed, sir. Thank you for that. Now I'm coming to the question on 18% that I told you I'm parking to
Hmm.
take a few earlier questions first. So somebody has just written to us that, sir, I have been investing for more than 15 years now. And when I go back and look at my portfolio, on an average, my return has been always single digits. It has always been in mutual funds. However, my return has never crossed 10%. Can you suggest how is it that you are getting 15 and 18% returns?
So to get the 18% return, if you get, you are the genius, I think, on a long run basis. That's I have observed. Even the best of best investors, Warren Buffett, has multiplied, has got his return of 18% over 84 years of his life now. And he's a billionaire today. He invested only $1,000, and today his wealth runs into few hundred billions dollars. 15% return is the average return on a long run basis one can expect from the equity market, provided we invest at a right opportunity in the stock market, and through debts and good quality corporate bonds and bank FDRs. Probably we can expect around 8 to 9% return because their risk is less, so return is also less. So if you have a blend of let's say bonds plus equity plus some investments in gold and property, blended average return 14-15% is very easy to get from the Indian market. And if you are investing in overseas
Okay.
market, perhaps your return will be lower in terms of percentage, but your purchasing power will be higher because the currency will appreciate and take care of the appreciation there. And there in those countries, inflation rate is also low. So your purchasing power parity wise, you will get higher returns. And dividend yields are very, very good there. So overall, total shareholders return will be much, much higher, Rakesh.
So can you recommend to an average Joe like me who is keen to invest in US? I want to invest in tech stocks in US. I want to invest in the blue chip companies in the US. what are the platforms available for me? Is that an avenue which is easy for somebody like me to invest in, or is it very difficult?
It's not right now very difficult, but you have to register through an online stockbroker based out of US. And if you are investing beyond a certain limit, maybe RBI permissions will also be required because RBI allow up to $250,000 to be remitted every year from a single individual without any permission. If you are investing more than that, there are certain regulatory requirement, approval requirement will come into play.
Okay. So there are many other questions from the viewers who was keeping on coming, but there are a couple that I had reserved for you. I would like to ask them to you. One of the questions is, and we want honest, candid answers from Mr. Shantilal Dugar. One, the question is, what is one financial decision that you wish you had made early in your life when you look back?
So one financial decision, I would say I should have invested in property at an early age in Mumbai or in whichever metro cities or second tier metro city in India. I have been like avoiding this investment because I was mostly abroad in the cream age of my life, the youth age, what you call it. So I did not have opportunity to invest in India. If I would have invested, probably my wealth creation would have been a little bit more. But anyways, that's the lost opportunity. You should not never repent. Whatever you have, God has given you more than what you need to survive. So we should be thankful for that.
Sure, sir. Thanks for that. Uh, Another question that has just come up. Uh, what is the best option to invest in gold, according to you?
Invest in gold. I think there are some gold related mutual funds also, but I would suggest if somebody really wants to invest in gold, just directly buy the gold coins or gold bar and keep it in a safe custody like lockers. Because that's the real asset you are holding it with yourself. If you go through the mutual fund route, probably you will shirk off 2.5%, 3% out of your total appreciation as a commission to the mutual fund company. So your net appreciation may not be as high as.
Sir, just checking. As I'm thinking about it, isn't physical gold purchase also taking off? There is a making charge I end up giving the jeweler. If I'm keeping it in a bank
Don't
locker,
buy
there are
jewelry.
annual fees I have to pay the bank.
No. Don't buy jewelry. Just buy gold bars, pure 24 carats gold bar.
No. Even a gold coin, sir, has a making charge to it nowadays. I went and purchased a 5-gram coin. I had to pay making charge for that.
Like white coins, you just buy the bar ना पूरा सिल्ली जो आता है गोल्ड का सिल्ली
बार बहुत बड़ा लेना पड़ेगा ना 5 ग्राम के लिए.
It will be available without any making charges.
Okay.
You can buy
fair.
easily.
Thanks. Another question from Naveen. Which is the better investment plan, sir? Is it ULIP, which is insurance plus investment, or is it ELSS? Because both have tax savings.
So it depends on your objective. If you really want tax saving, then I would say equity linked tax saving schemes are better. And if you want capital appreciation and savings, then without any security, then ULIP could be the one.
Okay. A question from Smith. If you want to go for derivative segment in stocks, what are the topics we must have knowledge of?
So that's a very specialized field. If you really want to venture into derivatives, then read my books on options, futures, and hedging. I think it's a very specialized field. And without having a very deep knowledge of call options, put options, cross currency swaps, and how to take benefit of all these options and future strategy, we should not venture. I would not advise. But if you feel confident and competent, then definitely these also help in optimizing the return on your investments. These are good hedging strategy.
Sure. Thank you. There are some 11, no, now 12 questions, which are all on the same lines. I've been holding on from asking, but we were kind of expecting questions like this. These questions largely, 13 people have asked, can you please suggest what are the best mutual funds? And part of it is, can you please suggest what are some good stocks to invest in? So there are almost 13, 14 people who have asked very similar questions.
So mutual funds, personally and frankly speaking, I am not in favor of investing through mutual funds, because if you invest through mutual funds, they charge some 2.5% management fees on top of their expenditure, lavish expenditure, what they incur to manage the portfolio. So whatever is the left out savings comes to as your appreciation through NAV increase. So personally, I am not in favor, but if you are not financially savvy and you do not have time to invest, to do your own equity research and do your own due diligence little bit, then you can take the mutual fund route. But otherwise, my humble and sincere advice is at least do some basic research. Even if you go through the mutual fund route, which mutual fund to choose, growth linked, debt linked, equity linked, or property linked, which mutual fund to choose, do the some basic homework and due diligence before you invest through mutual funds. Don't just invest in any kind of mutual fund, because many mutual funds have gone bankrupt and taken away investors' money.
Sure. A question on crypto. How do you recommend crypto investments in today's day and age?
I don't recommend at all, because I personally have never invested and not fond of crypto at all. I don't know the business model of crypto, how it is surviving as a asset class. No basis, no collaterals, and still it is being used as a investment and asset class without any basis. So I am dead against investing in crypto. Not even
But
get
sir,
the knowledge of it. Yeah.
especially that Bitcoin has now become part of sovereign wealth funds also, and it has crossed
So,
$120,000.
mm, so someday it will collapse, and which day it will collapse, I don't know. Maybe in my lifetime or maybe after my lifetime.
Okay. Uh, there are 3, 4 quick fire questions that I would like to ask you to get your perspective, sir.
Hmm.
So the first one, SIP or lump sum?
If you have recurring income, I would say SIP. But if you have some accumulated income come from somewhere, then always go for lump sum investment, big investment at the beginning when the market is ripe in your favor. But SIP is all the time good. Good. As I said, the value of annuity is much bigger. As I shown you in the compounding example, na? If you invest regularly, it compounds very fast, much faster than
Sure.
lump sum
Thanks.
investment. Yeah.
Gold or bonds?
Depends on, again, your risk and return appetite. If you want to invest for long time, then gold is a good instrument. But for 3, 4, 5 years horizon, I think bond will give you reasonable return.
Real estate or REITs?
Real estate.
Is REIT a good option?
Yeah, they are good options, but again, they give you the units, and then the like NAV increases. So you become part owner of that asset. Whereas real estate, you are the full owner and the asset is under your control. But only in real estate, I would give a caution here that whichever city you are living, try to invest there and keep the asset under your custody with fencing and all those. Nowadays, hear many cases where empty land, vacant land was there, and somebody else has made a fence around it, and then the asset becomes under litigation. And though on paper you are the owner of the asset, but physically some mafia linked with political parties and gundas, they possess the land. So don't venture into such places where you do not have everyday physical presence.
Got it. So the last question, in fact, in one of your initial slides, you had recommended uh, how do you take fixed cost away and move most of it into variable.
Hmm.
Uh, were you also referring to rental yield or rental apartments rather than purchasing an apartment? Uh,
No,
or
no. Apartment,
rephrasing
I
the
said
question.
that was from the car example. Renting a car versus owning a car. Owning a car will
Okay.
incur your fixed expenditure of driver, maintenance, insurance, registration, many things. Whereas if you rent it, you pay as you use. If even if you are out for, let's say, holidays, 1 week, 10 days, 30 days, 20 days, you are not incurring as a driver salary. So it is straight away saving to your wealth.
So when it comes to properties, you think it's a good idea to leverage home loans to buy properties?
Yeah, because the if you pay rent, whereas if you pay interest, normally EMI is equal to interest, and on loan interest you also save tax, right? So net of tax, you pay much lesser compared to the rent you pay, and in the process, whatever capital appreciation happens is your own appreciation. So net you will save much bigger amount instead of renting. If you have some sufficient cash flow in the beginning, as I said, first little bit of bucket you have to keep full so that you can make some down payments. Rest can be borrowed from the banks, home loan companies.
Sure. There are many more questions that has come that can be addressed, but we do not have the time, unfortunately. So I'm just sharing with everyone that we will collate all these questions and send it to Shantiji. We will take his responses and share back with the people who asked it. In fact, if many of you are keen, we would like to keep a part two of the wealth series, which can go a little more granular. Okay, some funds that I can invest in, some platforms that I can leverage in. We can get various people from within Opus who are leveraging technology for their own investments, right? So, for example, I know of people who are using platforms like Vint Wealth for bond investments, certain platform like Vested for US investments, and different platforms for comparison. So if there are enough people who have keenness for financial acumen and personal wealth, then we can continue the series, move on. So please do write back to Birla Opus Learning, and there'll be a link shared with each one of you for your feedback. But I believe this was a very engrossing and engaging conversation. And thank you so much, Shantiji, for that. As
Thank you.
promised, we will share the slides with everyone because many people have asked that. And we have also recording the session. So we'll send the recorded link for our colleagues who have not been able to join it. At the end of the webinar, we'll share all the questions so that we can provide an answer to the people who asked it as well. So thank you so much for enlightening all of us, Shantiji, and look
Thank you,
forward to
Rakesh.
continuing this forward.
Thank you, and wishing all the best to all the participants.
Thank you.
Healthy and wealthy and prosperous life for forever.
Thank you.
Okay, bye.